Welcome to the LRF Group podcast. I'm your host, and this is Keeping Current, your weekly briefing on housing and economic trends that matter most to South Florida buyers, sellers, and investors. Today, we're breaking down the latest data from Wells Fargo Home Mortgage's Keeping Current report, dated April 17, 2026. A lot is happening in the economy right now, from mortgage rates and home sales to oil prices, inflation, and the labor market. Let's get into it. Mortgage rates. Let's start with the number everyone wants to know: mortgage rates. The 30-year fixed rate conforming mortgage averaged 6.3% for the week ending April 16th. That's a 7 basis point drop from the prior week and a meaningful improvement from 6.46% just 2 weeks ago. To put that in context, the rate averaged 6.18% in March and 6.05% in February. Over the past 52 weeks, rates have averaged 6.41%, with a high of 6.89% in late May and a low of 5.98% at the end of February. The trend is encouraging. Rates are moving in the right direction, and every fraction of a point matters when it comes to monthly payments and purchasing power. Existing home sales. Now let's talk about what's happening in the housing market itself. Existing home sales fell 3.6% in March to a seasonally adjusted annual rate of 3.98 million homes, the lowest pace since September 2024. For context, existing home sales totaled 4.06 million units all of last year. However, there is a silver lining. First quarter sales, according to preliminary figures, are up a slight 0.2% over the first quarter of 2025. So while March was soft, the broader trend is holding. Inventory is also worth noting. The number of existing homes on the market at the end of March stood at 1.36 million units, up 2.3% from March of last year. More supply is coming to market, which is good news for buyers who have been frustrated by limited choices. As for how long homes are sitting, the median time on the market in March was 41 days, up from 36 days a year earlier. Properties are taking a bit longer to sell, which gives buyers slightly more negotiating room than they had 12 months ago. Oil prices. Now, a topic that has major ripple effects across the entire economy: oil prices. Oil prices have surged dramatically over the past 7 weeks, driven by the escalating conflict with Iran. The recent daily peak for West Texas Intermediate crude oil hit $114.58 per barrel on April 7th. As of April 14th, it stood at $100.72 per barrel. To appreciate how dramatic this move is, the average price in February was just $64.51 per barrel. We are now well above that level, and the implications for energy costs, transportation, and consumer spending are significant. The highest weekly average price over the past 5 years was $120.41 in mid-June 2022. We are approaching that territory again. This is a macro risk that every real estate professional and homebuyer should be watching closely. Inflation. Higher oil prices feed directly into inflation, and that's exactly what we're seeing. The Consumer Price Index jumped 0.9% in March, largely driven by a 10.9% surge in the energy component. Year over year, the CPI is now running at 3.3%, up from the 2.4% pace set in both January and February. The core CPI, which strips out food and energy, was more contained, posting a 0.2% gain in March, matching February's increase. Year over year, core CPI edged up to 2.6% from 2.5% in February. On the producer side, the Producer Price Index grew 0.5% in March, matching February's increase, and is now up 4% over the past year. The PPI has been accelerating since mid-2023, which suggests that upstream price pressures have not yet fully worked their way through to consumers. The bottom line on inflation: the energy shock from the conflict with Iran is pushing headline inflation higher, while core inflation remains more stable. The Federal Reserve will be watching this very carefully. The economy and GDP. Let's zoom out and look at the broader economy. After strong 4.4% annualized growth in the third quarter of last year, the economy sharply decelerated in the fourth quarter to just 0.5% annualized growth, a downward revision from last month's estimate of 0.7%. For the full year 2025, the economy grew 2%, measured fourth quarter over fourth quarter. In 2024, it expanded 2.4%. So we are seeing a clear deceleration trend. The first official estimate of first quarter 2026 GDP growth is scheduled for Thursday, April 30th. Given the geopolitical turbulence and energy price shock, that number will be closely watched by markets, the Fed, and policymakers alike. The labor market. Now let's look at jobs, because employment is the foundation of housing demand. Employment grew by 178,000 payroll jobs in March, according to the Bureau of Labor Statistics. That sounds solid until you look at the context. February saw a loss of 133,000 jobs, revised from an initially reported drop of 92,000. Taken together, the two-month average is just 22,500 jobs per month. In all of 2025, monthly job growth averaged only 9,700, so the labor market has been fragile for some time. Now here's the nuance on the unemployment rate. The headline number edged down to 4.3% in March from 4.4% in February, which sounds like good news. But a closer look tells a different story. The number of jobs counted by the household survey actually dropped by 64,000 in March. The unemployment rate fell only because the civilian labor force shrank by 396,000 people. In other words, people left the workforce entirely. They stopped looking for jobs. When that happens, the unemployment rate falls for the wrong reasons. The more inclusive U6 unemployment measure, which counts discouraged job hunters and those who are marginally employed, actually moved in the opposite direction, rising to 8% in March from 7.9% in February. The labor market picture is more complicated than the headline suggests. The 10-year Treasury. Finally, let's talk about the 10-year Treasury yield, one of the most important benchmarks for mortgage rates. The 10-year Treasury's daily yield was 4.29% on April 15th, down from a recent high of 4.44% on March 27th. It averaged 4.31% in the first half of April, after averaging 4.25% in March and 4.13% in February. Over the past year, the daily yield has averaged 4.23%, with a 52-week low of 3.97% and a 52-week high of 4.58%. The direction of the 10-year Treasury will continue to be a key driver of where mortgage rates go from here. If geopolitical tensions ease and inflation pressures moderate, we could see yields and mortgage rates pull back further. If the energy shock persists, the opposite is true. So what does all of this mean if you're thinking about buying, selling, or investing in South Florida real estate right now? Here's the takeaway. The market is navigating a complex environment. Mortgage rates have come down from their highs and are trending in the right direction. Inventory is improving, but inflation is reaccelerating due to the energy shock. The labor market is softer than the headline suggests, and GDP growth is slowing. In times like these, having a trusted advisor who understands both the macro picture and the local market is more important than ever. If you have questions about what today's economic environment means for your real estate decisions, whether you're buying your first home, selling a luxury property, or building an investment portfolio, reach out to the LRF Group. We're here to help you navigate with confidence. This has been Keeping Current, brought to you by the LRF Group, affiliated with Berkshire Hathaway Home Services EWM Realty. Our services for your world.